Many investors are faced with the challenge of evaluating externally managed funds. Of course, it is easy to identify managers who have excelled in the past. The problem is, how do we identify the ones that are likely to do so in the future? This is a vital distinction. Northfield has created a three-step process that seeks to identify managers who are more likely to produce superior results in the future. The first step is classification. In order to compare a manager to their peers, we have to know who the peers really are. They're not always who the manager says they are. The second step is to select the correct time horizon. Every manager has a unique history and needs to be evaluated in a time period appropriate to that history. Once this groundwork is done, the third step is to use the correct performance metrics to evaluate a manager. Using the ART application, we will walk through these steps one at a time. It's been said that the best way to win a contest for the largest tomato is to paint a cantaloupe red and hope the judges don't notice. By performing returns-based style analysis, we determine what a fund was actually doing as opposed to how they labelled themselves. This allows us to choose the right benchmark to correctly evaluate managers in the context of an appropriate peer group. However, a manager may try to beat this game by saying one thing and doing another. Consider a manager who pursues an aggressive strategy, perhaps by over-leveraging an index fund. If the manager claims that this aggressive fund belongs to a conservative peer group whose benchmark is the under-leveraged index, the fund will always excel in rising markets. The same manager could do the opposite for another fund in the same family. Depending on market conditions, one of the two funds will always outperform its peers, producing a marketing advantage to the fund sponsor. The style history chart shows how a manager's style has changed over time. A unique feature of Northfield software is that we calculate and display confidence intervals for our style assessments. Only with the confidence intervals can we discern meaningful style assessments from the statistically insignificant. For example, an allocation estimate of 10% plus or minus 30% is statistically insignificant. Time horizon matters. The same manager measured over 3 different time spans will show very different excess returns. There is an industry tradition to use standardized time periods, perhaps 1, 3, 5 or even 10 years. The problem with this one-size-fits-all attitude is that the period may not fit with the unique history of the manager or fund. If the portfolio manager was fired 3 months ago, then what happened 5 years ago is not very meaningful. Almost all of the academic literature in this area says that if past returns are meaningful at all to future performance, it is a short-lived effect. A better approach is to find the most relevant period for each manager, based on observable patterns in their performance. One manager's relevant period may span a few months, another's may span years. With customized time periods, we can capture structural changes in a manager's process and therefore likely future performance. This is where CUSUM enters the picture. The CUSUM algorithm gives us a consistently derived signal to find the right time horizon for each manager. The CUSUM technique is extremely common in industrial process control and became well known for monitoring the quality of telephone production for AT&T more than 50 years ago. In this example, we measure the telephones as they come off of the assembly line. We plot a time series of their measurements against the standard. Phones that are inside of the green band are within tolerance and accepted. Phones that are above or below the band are out of tolerance and rejected. Now we will put aside telephones to consider the fund manager who produces returns every month. The manager operates a kind of assembly line, generating excess returns versus a peer group. The only difference is that we are searching for excess returns in the upper region, not the middle band. CUSUM takes this process control a step further by mapping the cumulative sum of these differences. The measure highlights trends in the time series before the measurements actually pass a threshold. In the case of fund managers, we're looking for structural changes that would indicate continued performance in the green zone. Let's observe a physical example of structural change, the Nile River. The flow volume of the Nile has been measured for thousands of years and basically appears to be random. If we convert the time series to percent change, it also appears to be random. However, the cumulative sum, or CUSUM, of these changes shows a very different pattern. There is a strong inflection point in 1898 indicating a structural change, a shift from increasing to decreasing changes. This is precisely the year that construction began for the Aswan Dam. In fact, each inflection in the Nile CUSUM chart can be traced to changes in the network of dams. Let's look at the case of a well-known growth mutual fund as an example. We start with the price history of the asset and a carefully selected benchmark. We convert each of these to absolute returns. Then we subtract the benchmark to calculate relative or excess return for the fund. From the excess returns, we calculate the information ratio, which is the ratio of excess return to risk. We calculate the changes to this information ratio. So far, each of these charts looks basically random. In the final step, we calculate the cumulative sum of the information ratio changes, the CUSUM. This chart does not look random at all. There is a major inflection point in 1984. This indicates a change in trend, a structural change in the game. And in that month, the fund made a major change in strategy. Without knowing the fund's strategic history, CUSUM was able to detect a statistically significant structural change. We set our custom time period to begin at this inflection point. We have done style analysis to find the right peer group for our manager. Then we used CUSUM to determine the best time horizon to represent their performance. Only with these two steps done right can we proceed to analyse their performance properly. To complete the analysis, we need a process that can separate genuine performance from market noise. What numerical metric can measure skill versus luck? Some widely used performance metrics, such as the information ratio, are not congruent to investor goals, except in very special cases. Northfield has studied a performance metric called the precision-weighted excess return and expects to publish these results in a professionally refereed journal. The precision-weighted excess return starts by simply computing the excess return of a fund against a benchmark over the period determined by CUSUM. If the observed results are due to skill, this excess return represents the manager's value added. If the observed results are due to luck, then we can only say the manager's value added is the same as the average of their peers. To examine the likelihood of manager results being due to skill versus luck, we look at the dispersion of the manager's excess returns, called tracking error, in comparison to the dispersion of peer group excess returns. The broader the dispersion of the peer group excess returns, the less confident we are that the manager's returns are distinguishable from the group. On the other hand, we are also less confident that the sample excess return of the peer group is actually a good estimate. It follows that we can use the peer group return dispersion and the manager's tracking error to make a weighted average of our two contending values for excess return, the skill estimate versus the luck estimate. This weighted average is the precision-weighted excess return. This metric is just one example of the way that tools in the art software can be productively applied to real-world problems that face investors doing asset allocation. In a Northfield empirical study, this method was tested on thousands of US domestic mutual funds, international funds, and hedge funds. Empirical research confirms that using CUSUM and precision-weighted returns is useful for predicting active returns for the following 12-month period. This preliminary analysis suggests that the methodology can lead to economically meaningful improvement in investor returns, which is the ultimate goal. Art is the tool that enables this analysis, proper classification, the right time horizon, and correct performance measurement. With this powerful decision support tool, we are able to evaluate managers and funds in a consistent, logical process that represents the edge of financial research. We encourage you to consider adding this innovation to your firm's asset allocation decision-making process.